Good morning. These are the things that matter most in Europe's market today. Oil is still falling, the AI trade is being stress-tested, and Europe's policy and supply chain questions are getting harder to ignore. The central question for private investors is simple. Is this a healthy relief trade, or is the market starting to rotate away from yesterday's biggest winners? Start with oil. CNBC and Investing.com reported that crude extended its losses as the pause in U.S. Iran hostilities raised hopes of lasting de-escalation. The live market snapshot showed Brent near $88, down about 0.6% after the larger fall the day before. For Europe, that keeps inflation and input cost pressure moving in the right direction. The cleaner side is airlines, chemicals, and fuel-sensitive consumers if lower energy holds. Pressure sits with the producer basket, where Shell, Total Energies, and BP need to show they are more than a geopolitical risk premium trade. For private investors, the takeaway is to separate lower oil from a full all clear. Relief helps margins, but it does not automatically fix demand, rates, or geopolitical fragility. Second, the AI trade is facing its first real confidence test in days. CNBC reported that SK Hynix fell sharply in Seoul as the chip sell-off deepened. FT and MarketWatch both flagged rising concern around AI funding and credit risk, including NVIDIA-linked data center financing and the possibility that circular financing is becoming part of the AI story. That matters for Europe because ASML, Infineon, and Schneider Electric are not just technology names. They are confirmation names for the entire AI infrastructure chain. The cleaner side is real orders, power equipment demand, and disciplined balance sheets. The pressure side is any AI label that depends on easy financing or cannot translate the boom into cash flow. For private investors, the takeaway is proof over narrative. If AI infrastructure is healthy, European suppliers should confirm it. If credit worries dominate, the market can punish the whole chain even when long-term demand still sounds strong. Third, Europe still has a rates and currency filter. U.S. futures were softer, the euro was slightly weaker against the dollar, and FT reported that the Bank of England could raise rates this year if energy prices stay high. That keeps the European market from reading lower oil as a simple broad risk signal. The cleaner side is banks with strong credit books and companies with pricing power. Pressure sits with real estate, leveraged small caps, and long-duration growth stories if investors decide rates cannot fall as quickly as hoped. For private investors, the practical takeaway is this. Falling oil can ease one pressure point while rate risk remains alive. The underappreciated story is critical minerals. FT reported that funding gaps are hobbling Western critical mineral objectives. This is quieter than oil or AI, but it matters because Europe's energy transition, defense supply chain, and semiconductor sovereignty all depend on raw material security. Potential winners are companies tied to diversified supply, recycling, grid equipment, and industrial electrification. Pressure sits with projects that need cheap capital, policy certainty, or long lead times before they can become investable. For private investors, the takeaway is that strategic importance is not the same as investability today. The supply chain theme is real, but the market still needs financing proof. Here is the stock-led watch list. For oil relief, watch Ryanair, IAG, and BASF to see whether lower fuel and input costs support margin confidence. For energy pressure, watch Shell, Total Energies, and BP to see whether producers lag or prove resilience. For AI stress, watch ASML, Infineon, and Schneider Electric for confirmation from orders, power demand, and capital discipline. For rates and credit, watch BNP Paribas, Deutsche Bank, and Vonovia to test banks versus rate-sensitive real estate. For critical minerals, watch Schneider Electric, Siemens, and Glencore as a practical supply chain and electrification map. Market bias, selective and proof-driven. Europe can benefit from lower oil, but the softer U.S. futures, chip pressure, and rate uncertainty argue against treating the morning as a broad risk-on signal. The mistake to avoid is buying the relief story without checking the confirmation baskets. Today's useful filter is margins, AI credit quality, rate sensitivity, and supply chain financing. That is the Europe Morning Market Brief. We will be back tomorrow at the same time with everything that matters. Research context only. This briefing is not investment advice. It is not a recommendation to buy, sell, or hold any security, and it does not include price targets, stop losses, position sizing, or personal financial advice.